Look around your living room right now. You've likely got a smartphone on the table, a streaming service playing on the TV, and a pair of name brand sneakers by the door. Every time you pay a monthly subscription or upgrade your phone, you are sending your income to these specific companies. You are making them wealthier with every routine purchase. There is a way to change that relationship. You can move from being a consumer who hands over money for a product to a partial owner of the business that makes it. Shifting your mindset from buying stuff to owning assets is the first step to building generational wealth. When you own a piece of the business, your money begins to work for you. For most beginners, the stock market looks like a chaotic, intimidating floor full of people yelling and complex numbers on a screen. In reality, a stock is a real-world business divided into millions of equal pieces. Purchasing one gives you a legal right to a portion of that company's future profits. You partner with the business, claiming your share of what it earns. Think of the stock market as the mechanism that allows everyday people to team up with the most successful businesses in the world. Once you hold that status as an owner, the business begins to generate personal revenue for you in two specific ways. The first is through equity. As the overall business succeeds and grows, the market value of the company rises. Because you own a piece of it, your individual slice becomes more valuable over time. The second way is through dividends. Many companies choose to pay out a portion of their profits to investors every quarter. It is a steady stream of passive income paid to you just for holding the stock. To see how this works over time, look at Netflix. $1,000 invested in their equity in 2008, when they were still mailing red DVDs, would be worth roughly $80,000 today. This is true passive income. You are being paid through both rising equity and quarterly dividends, without having to exchange your labor for a paycheck. Building wealth doesn't require a fortune. Consider a simple $2 slice of pizza. Buying one every day adds up to $730 over a year. This chart compares that daily expense. If that money is spent, it's gone forever. But if that same $730 is invested annually at a steady return, it grows to over $3,000 across 30 years. When you reinvest your dividends to buy even more shares, you trigger a feedback loop. Your original money earns interest, and then that interest begins to earn its own interest. This cycle causes your investment to grow at an increasingly sharp angle. Wealth creation relies on time and consistency. Reinvesting your returns allows your money to do the heavy lifting, while you remain patient. Most new investors fear picking the wrong company and watching their investment disappear if that one business fails. You can remove that risk by using an index fund. It is a tool designed for beginners that allows you to buy into the market without having to pick individual winners. An index fund acts like a pre-packaged basket. Instead of owning one company, you own tiny slices of the 500 largest businesses in the country all at once. This provides a mathematical safety net. If a few companies in the basket have a poor year, the growth of the other hundreds of businesses balances it out, keeping the overall container expanding. Index funds eliminate the need for guesswork. They protect your money through built-in diversification, ensuring you grow along with the top tier of the economy. To start your journey as an investor today, you only need to follow a few mechanical steps. First, calculate your free cash flow. This is simply your total monthly income minus your necessary living expenses. Second, commit to paying yourself first. Move that free cash flow into a brokerage account before spending it. Third, focus on stability. Move 60 to 70% of that cash into an index fund to build a diversified foundation. Finally, use the remaining portion of your cash to buy individual slices of the brands and businesses you already use and understand. Investing is not reserved for financial experts. It is a repeatable process of redirecting your existing cash flow into assets that grow over time. At the end of the day, you must decide your goal. Is it to look rich right now or to be wealthy for generations? Looking rich involves spending your income to acquire the latest products and labels today. Being wealthy means owning a piece of the companies that create those products and drive the global economy. Patient, consistent investing is the mechanical process of buying back your own time. By holding assets that grow while you live your life, you provide your family with a financial advantage that remains for years to come.